Hey guys, Dillon Loomis here. In this episode, I want to share a different perspective about Tesla's eventual inclusion into the S&P 500. Of course, there are financial implications, but the timing of their eventual inclusion validates something much bigger than just hitting some financial metrics. In case you need a refresher, these are the requirements to be eligible for S&P inclusion. As you can see, some of these requirements lean toward being subjective rather than objective, like most of its shares in the public's hands. Without getting into too much detail, the only objective left for Tesla to hit is the last one. The sum of the previous 4 quarters of earnings must be positive, and the most recent quarter must also be positive. Tesla has posted GAAP net profits for the last 3 quarters, and there's a decent chance they can pull it off for Q2 of this year as well. If they can pull this off amidst a global upheaval, one in which their main factory in Fremont was shut down for over a month this quarter, they will become eligible by the metrics for S&P inclusion. However, enter David Blitzer and Philip Murphy. So who is David Blitzer? I'm glad you asked. He's not a household name, but as a longtime chair of the index committee for S&P Global, he's led the team that decides which companies go into the S&P 500 index. The key word here is decide. Ultimately, S&P inclusion is not just hitting financial targets, but each company must be approved and selected by a committee for inclusion. Blitzer retired last year after 24 years at the helm, and he was replaced by Philip Murphy. The curation of the S&P 500 is guided by strict rules, but these are sometimes open to interpretation, making inclusion a mix of art and science. Essentially, the S&P 500 is a list. Once a quarter, stocks are added or removed as rules change and companies grow, shrink, or merge. The details of adjustments to companies' weights in the index can be rather subjective and not nearly as mechanical as the funds and trackers that are passively invested based on composition. Unlike the Dow, which you calculate by adding up the prices of the component stocks and multiplying by a constant, the S&P 500 is more complex. With the S&P, you take the company's float-adjusted market cap and add these figures together. Float-adjusted just means counting only the shares available to ordinary people, excluding shares held by management, by government, and other companies. For example, Apple reported 4.8 billion float-adjusted common shares in Q4 2018 and had a share price of $148. Resulting in a free float market cap of $711 billion. The market caps for all 500 constituent stocks are summed up to obtain the total market cap for the S&P 500. This value is used as the numerator in the index calculation. The individual market weights are calculated by dividing free float market cap of a company in the index by the total market cap of the index. As of January 2019, the total S&P market cap was $23 trillion, meaning Apple had a 3% market weight. Overall, the larger the market weight of a company, the more impact each 1% change in a stock's price will have on the index. Shifting back to Tesla, according to Yahoo Finance, they have 185 million shares outstanding and a float of 147 million for a 79% public float. In this case, shares outstanding refers to the total number of shares a company has issued, while the public float are shares that are publicly owned, unrestricted, and available to the open market. As you can see from this insider roster, we get a rough approximation for shares owned by insiders. This accounts for roughly 37 million shares, or 21%. Another 57% are held by institutions. The remaining shares are either held by the public or are restricted. These restricted shares are common practice for execs and other employees to receive stock as part of their compensation package. These shares are considered part of shares outstanding, but because they aren't available for everyday trading, they're not considered a part of a company's public float. Alright guys, let's land this plane. Some key points to take away. If the public float is well below the shares outstanding, it means a high proportion of the company is employee owned. If the public float is well below the shares outstanding, the stock price has the potential to be volatile, as there are fewer shares trading at any given time, whereas a larger public float can mean less volatility. If the number of floating shares is very close to the shares outstanding, it means there is little employee ownership in the company. I was a financial advisor for 3 years, so I tend to get carried away with market talk. But for S&P 500 inclusion, at least 50% of a company's shares must be available for public trading, which, as we now know, Tesla has that box checked with their 79% float metric. However, we must briefly mention the S&P Index Committee. Philip Murphy is supported by 9 Index Committee members who are full-time employees of S&P Global. They meet once a month to discuss potential revisions to the S&P 500. Votes by the Index Committee are decided by a simple majority, and each committee member's vote counts equally, even the directors. And guys, real quick, if you happen to see 505 companies listed in the S&P, it's just a growing trend among tech companies where they have multiple share classes. So these 5 companies will be listed twice. The last thing I want to touch on before what really matters here is the financial implication of S&P 500 inclusion. When the committee announces the addition of a new company to the index, the stock does frequently rise, at least temporarily. This is largely caused by the funds tracking the index adding the company to their portfolios. In 2011, researchers at the New York Fed found that all things being equal, a stock's inclusion in the S&P 500 did not result in a permanent increase in market value. So the main takeaway here is yes, Tesla will most likely see a short-term boost in stock price between 3 and 7% in the near term upon their inclusion. This will be strongly driven by the index funds adding Tesla to their portfolio, but long-term there shouldn't be any direct price fluctuations stemming from their inclusion alone. So, you may be asking, Dillon, why are you spending so much time on these seemingly trivial points? I'm glad you asked. Whether Tesla becomes eligible for S&P inclusion this quarter or another subsequent isn't a big deal either way. These past 4 quarters are telling the story of a company who has found a way to be profitable while in a hyper-growth phase. Pair this with a global pandemic the world hasn't seen in some time, in which the Fremont factory was closed for over a month, and you have proof of a streamlined, optimized company that is set up to deliver massive numbers in the back half of 2020. With Giga Shanghai ramping quicker than expectations, Tesla believes Model 3 will achieve a production rate of 4,000 per week for an extrapolated run rate of 200,000 per year by, right now, mid-2020. Model Y production is ramping and quality issues are being sorted out rapidly in what should make for very strong numbers in Q3 and 4. But rather than listing out all of the positive catalysts thrusting Tesla forward, let's just answer the one major question people have had about Tesla. Do you remember everyone asking, can Tesla survive a global recession? This was a trending topic this spring, and look, guys, we now have the answer to this question. And sure, the global situation is yet to play out, but one could argue the worst of it is behind us. We're about to have factual evidence in a few days that Tesla has indeed survived a recession, and perhaps even thrived, at least relative to the rest of the auto industry. With over $8 billion in cash on hand at the end of Q1 this year, Tesla is in the most bulletproof place they have been since their inception. Alright guys, that's it for this episode. If you enjoyed it, please like it, subscribe if you haven't, and I'll see you guys all tomorrow.